We're going to calculate the stock price for STOR Capital, and this is a REIT. And the first thing we're going to do is get the market cap, 4.73 billion. And then the stock price, 1934. So the market cap divided by the stock price equals the shares outstanding. They have 245 million shares outstanding. Next is free cash flow. And the best way to calculate the stock price for a company is to estimate future free cash flow and discount that number back to today's dollars. So we'll just look at the cash flow statement in Yahoo Finance, get that number. Next is net income, which can be found in the income statement, and that's the profit and loss. And last is revenue, which is also in the income statement. So it's good to see the revenue has increased year after year consistently. So has net income and free cash flow. So those are all good signs so far. Now we need to look at the capital structure of this company and figure out the discount rate we need to apply to the future cash flows. So the interest expense is $148 million. That's the interest they pay on their debt. And now the liabilities section to find out the current debt. And this is on the balance sheet. The long-term debt of $3.6 billion. So that's gives them an interest rate of 4.12%. But interest payments are tax deductible, so let's find the effective tax rate. Oh, this is a REIT. So REITs don't pay taxes, because 90% of the profits from a REIT gets paid to the shareholders, and the shareholders pay the taxes on the dividend payments, not the REITs as a corporate entity. So they have 43% of debt in a capital structure, which is kind of high. Now let's look at the beta. The beta of 0.98, that's a pretty good beta. That means the stock moves with the market. So the cost of equity is 9.85%, and that's calculated using a CAPM model, capital asset pricing model. And equity is more expensive than debt because equity sits lower in the capital structure of a company. In the event of a default, debt holders are paid before equity holders. So that's why equity holders require a higher return for the greater risk they're taking. And when you combine the equity and the debt, you get a WACC, a weighted average cost of capital of 7.38%. And that's the percentage this company uses to discount cash flows and also uses to value investments, because they need to get over this 7.4% in order to add value to its investors. So let's discount the cash flows by 7.4%. And we get free cash flows in 4 years, estimating in 4 years. And then we do a terminal value, which is all years beyond year 4. And then we discount those numbers back to today's dollars, and we get a value of $6.3 billion. And we divide that by 245 million shares. We get a stock price of $26, and it's trading at $19. So it's trading at a discount, a 25% discount. So we consider this a buy. And you can see the stock price was trading a little above intrinsic value for a while. Now it's come back down. So originally when I built this DCF model, I couldn't really value REITs too well. I did add a feature into the model to take into account when it's a REIT. That's why I put REIT here, so it looks into this cell. If it says REIT, then it does something a little different into the calculation. Now this is kind of a living, breathing entity, this model, so it's constantly changing based off of new information I receive every time I kind of do a discounted cash flow. So it can be challenging, and obviously this is not a perfect science. This is just an estimation, because everybody has their own opinion on on a stock. This is my model. It's my opinion. So thanks for watching.